broadcast is now starting. All attendees are in listen-only mode.
So, good afternoon everyone, and welcome to the third in a series of webinars where we're focusing on expatriate tax and global mobility issues. The webinar will be presented today by myself, Sarah Robert, and my colleague Charlotte Hobra. Now, we've gone through today's speakers, so I just wanted to have a quick word about UTN, or United Tax Network. The network specifically focuses on global mobility and expatriate tax issues, and we have contacts in about 110 countries, with each country specialising in international tax. We're here to help companies moving employees around the world, and the core services offered can be found on the website, and I'll run through a few of those quickly for you now. So we focus on assignment services, tax and social security planning, equity rewards advice, tax compliance and advisory, and payroll consulting and compliance. So today's webinar is going to be looking at a subject that affects both inbounds and outbounds to and from the UK, tax residents. So the first question is, why is this so important? As it's often the first thing we look at when we're talking to an assignee or a company about somebody moving. So the first reason that it's so important is that the country where an individual is tax resident usually has wider taxing rights than the country where an individual is non-resident. As a general rule, the country of residence will tax an individual's worldwide income and gains, and in contrast, if an individual is not resident in a country, that country has limited taxing rights and is restricted to taxing income and gains in that country only. So for example, I'm a resident of the UK. If I open a bank account in Spain, which generates bank interest, the UK will want to tax my worldwide income, including the Spanish bank interest. If, however, I leave the UK to work wholly overseas for my employer and break residence, but I have a UK house and rent it out while I'm away, the UK can tax my UK rental income because this income is generated from a property in the UK. However, the UK cannot tax my overseas or non-UK employment income. An individual's tax residence can also impact other bodies. So if an individual is the sole trustee of a trust, then an individual's residence in a certain country can make the trust resident in that same country. And the same can apply to a company, with one shareholder and director if that entity is managed and controlled exclusively by that individual. So a change in residence can make the company's residence change as well. And the last point, accumulated effect. Tax residence should be looked at on a year-by-year basis. However, it may be necessary to confirm an individual's residence status over several years, when there are certain tests in the UK, for example, which require an understanding of several years of residence. So for example, in the statutory residence test, which Charlotte will refer to later, there are different levels of day counting depending on whether an individual was resident in the UK in any of the 3 previous tax years or not. An inbound to the UK who is resident but not domiciled can claim a certain basis of taxation known as the remittance basis, but will need to pay a charge once he or she has been in the UK for 7 out of the last 9 tax years. I'll now hand over to Charlotte, who can go through some more issues that you will need to consider.
So one of the first issues to consider is that different countries have different tax rules to determine tax residence. So you always need to seek advice in the specific country. Don't just assume that one rule will fit all countries. Some countries, for example, look specifically at days spent in the country during the tax year, while other countries may look at whether you have a home in that country or whether you have family or social ties to that country. With respect to the day count, some countries like Ireland and the US will not only look at days during that particular tax year, they'll also take into account days from previous tax years to calculate whether you've exceeded the residence threshold for that tax year. Another issue to consider is that different countries also have different tax year ends. A lot of countries have tax years that are calendar years and end on the 31st of December, but the Commonwealth countries tend to have quite different tax year ends. The tax year in the UK, for example, starts on the 6th of April and ends on the 5th of April, which is quite unusual. Hong Kong and India are quite similar to the UK, as they start on the 1st of April and end on the 31st of March, but Australia and Pakistan's tax years in comparison end on the 30th of June. Different tax years and different ends can cause complications when someone's dual resident, and we'll discuss this when we talk about the role of the double tax treaty later in the webinar. It is possible in some countries like the UK to be resident for part of the tax year and non-resident for the rest of the tax year. This is most likely when someone arrives or leaves a country partway through the tax year. This is called being split-year residents and is a useful concession to ensure that income received in another country before arrival or after departure is not taxed twice. However, some countries, like Spain and Italy, do not have any split-year rules, and you're either resident for the whole tax year or non-resident for the whole tax year. If this causes dual residence problems, then the double tax treaty can usually be used to alleviate any double taxation situations. Sometimes, though, there are domestic concessions, which Sarah will talk about later in the webinar. Now looking specifically at the UK and the statutory residence test. In the UK, we have what's called the statutory residence test to determine someone's residence position. This is a detailed document of about 100 pages and can be quite complex. It was introduced by HMRC on the 6th of April 2013 for the tax years 2013-14 onwards, and it has been very useful in setting out the residence rules and enabling an individual to plan ahead with respect to their residence by potentially limiting their number of days in the UK. One important point to note is that when we talk about days in the UK, the usual way of counting is actually midnight spent in the UK. The statutory residence test essentially has three parts to it: automatic overseas tests, automatic UK tests, and sufficient ties test. Basically, you'll be considered non-resident in the UK if you meet one of the automatic overseas tests, or you'll be considered resident in the UK if you meet either one of the automatic UK tests or the sufficient ties test. The sufficient ties test determines residence based on number of ties to the UK. For example, when we talk about ties, we mean things like family, accommodation, and work, and then the number of midnights spent in the UK. This test often catches a lot of people who don't get caught by the automatic UK tests, so it's definitely one to consider. The test is a bit like a flowchart that you follow through until you meet one of the tests. Once you have met one of the tests, you don't need to continue any further. Following the guidance can be complex though, and it is advisable to seek specialist advice. Now moving on to double tax treaties. It is possible to be resident in two countries at the same time. This is called dual residence and can cause double taxation problems if both countries seek to tax the same income. The double tax treaty between two countries can be used to alleviate double taxation by determining out of the two countries where someone is treaty resident. It's important to look at the specific treaty between two countries, as each treaty can be worded differently. But generally, a treaty will determine treaty residence by looking firstly at someone's permanent home, secondly their centre of vital interests, and this means both financial and social, thirdly their habitual abode, and lastly nationality. Again, this is a bit like a flowchart, and if the first criteria cannot be met, then you move on to the second criteria. For example, if the individual has a permanent home in both countries, then this first criteria won't be met, and then you'll need to look at the next one, which is where the individual's centre of vital interests are, to determine where they're treaty resident. Once an individual's treaty residence position has been determined, then double tax is usually alleviated either through taking a tax credit in one of the countries or relieving the income from tax. This can be more complicated if the tax years have different end dates, and in this case it is usual to use non-coterminous year ends. For example, if a US tax credit is being taken in the UK, then usually the tax paid in the 2017 US tax year, which ends on the 30th of December, would be taken against the 2017-18 UK return, which ends on the 5th of April 2018. Now I'm going to pass back to Sarah to look at some client cases.
So the first case that we were thinking of here is a move to Spain. We recently had a client moving an employee to Spain at the end of March. The Spanish tax year, as Charlotte's already pointed out, is the calendar year, So the individual was going to exceed 183 days or 6 months in Spain in 2018 and trigger residence there for the entire calendar year, because you'll remember that Spain does not have a split year arrangement. However, the individual would also be UK resident for the first 3 months of 2018, basically to the end of the 2017-18 UK tax year. So we had a problem with an overlap for the first 3 months of the calendar year. We spoke to our contacts in Spain about the possibility of looking at the double tax treaty for the first 3 months, but as Charlotte has mentioned, they do actually have a concession domestically which allows us to get exemption in Spain for those 3 months, and that's known as the Beckham law. David Beckham was actually one of the first people to use and benefit from this rule, and I thought it would be very topical, as we're in the middle of World Cup season, to mention something to do with football. Unfortunately, the irony is now that football players are not allowed to make use of this on the basis that they probably earn enough and they don't really need to worry too much about their highest rate of tax. But it still is available for other individuals moving to Spain. So the rule that you can apply states that expatriates moving to Spain can elect to be taxed on their Spanish income for a limited period of time and exclude worldwide income. In addition, they are subject to a flat rate of tax rather than the higher progressive rates, and in other words, they're treated as if they are non-resident, and this is Spain's attempt to attract foreign employees and talent to the country. Now, there are several conditions which must be met, but my client met them, and therefore he was only taxed from April in Spain to the end of the year, and at a more favourable tax rate during that time, with no tax on any income outside of Spain. So that was a great result. We could have gone the treaty route, but we did actually have something from domestic legislation to avoid double taxation between the UK and Spain. Over to Charlotte.
The second client case, it's an example regarding a US national who came to work in the UK. For the first year that they were in the UK, they were resident in both the UK and the US under the UK and the US domestic rules. The treaty was then looked at, and they were considered treaty non-resident in the UK because it was determined that their centre of vital interest remained in the US. So for that first tax year, no income was declared in the UK because it was relieved from tax through the terms of the double tax treaty. However, it's important to note that HMRC do count a year of treaty non-residence when counting years for overseas workday relief. Overseas workday is a relief you can claim when you come into the UK for the first 3 years if you're non-UK domiciled. This meant, unfortunately, the individual did not therefore receive the benefit of 3 years of overseas workday relief because they were only allowed 2 years, as the first year of residence counted towards the number of years allowable, even though they didn't actually need to claim the relief in the first year because no income was being declared. This isn't a widely known rule, and it can catch people out if they're not aware of this.
So we've now got to the point where there are any questions, and I can see that we actually have a question here which is relating to the UK statutory residence test, and the question is, what kind of tests are in the automatic overseas section of the residence test? So maybe Charlotte can take us through those tests.
So there are three parts to the automatic overseas residence test. The first automatic test, if you have been resident in one of the previous 3 tax years before the tax year you're actually looking at, you will be automatically non-resident in the UK if you spend less than 16 days in the UK. So if you meet that test, you would automatically be non-UK resident. The second automatic overseas test states that if you haven't been resident at all in the UK for any of the prior 3 tax years before the tax year we're looking at, then if you spend less than 46 days in the UK for that tax year, then you would be non-resident again. Just want to point out again that when we're talking about days, we do mean midnights, as we stated earlier. The third automatic overseas test, which is called the full-time work overseas test, and this is the one that we tend to see quite a lot with global mobility because this relates to people going to work overseas. If you are working full-time overseas during the tax year and you spend less than 91 days in the UK and less than 31 work days in the UK, then you will be automatically non-resident. It is important to point out, though, that the Revenue do look very closely at this test to make sure that someone is actually working full-time, and there are quite complicated calculations to make sure that that individual is indeed working full-time. So if someone is not actually working full-time, only working part of the time, they may well therefore not meet this test. So it's important to make sure you have covered every criteria that this test asks you to meet if you want to use this test. It is one of the tests that HMRC do tend to look carefully at when they are reviewing someone's residence position.
Thank you, Charlotte. If any of you have any questions, you think of anything after this, then by all means you have now on the screen our contact details and we'd be happy to take any questions. And just for your diaries, the next webinar will be on Wednesday the 4th of July, where we're looking at temporary workplace rules, and you've got there the link on how to register. So we hope that's been very useful, and as I say, any questions, please feel free to contact us. Thank you.